Welcome back to the Daily Nugget. Property Insights Daily, 7 days a week, one question, 20 minutes or less. Myself, Lawrence Lotze, and today joined again by Matt Harris, property tax specialist and fellow property investor. Question to you for today, Matt, and I'll let you go through it and I'll give you my own example so you can give me some clarity, is GST and property in New Zealand. When is it applicable? When is it not? And, you know, a lot of people don't understand when they claim, don't claim. How does it work?
Yeah, I'm glad you're asking this question on the Nugget today. I commonly get phone calls and emails from first-time property investors who are coming to settlement and they want to know what their GST number is.
Yep.
So if you are a long-term residential accommodation provider, so a buy and hold investor, then residential accommodation is exempt from GST in New Zealand. And there's a really good reason for that. New Zealand has a famously simple GST regime with very, very few exemptions. But this one is one exemption that makes sense. In short, the government doesn't want to levy GST on residential rents. That is because it will obviously increase rents and increase compliance. So if you buy in a property and you intend to hold it for the long term and you're going to rent it out, then GST is not applicable. Conversely, if you're a dealer, a developer, or a trader in land, so basically someone who buys and sells property, flips property, whatever you want to call it, then you're not providing accommodation or dwelling, you are subject to GST. So in the ordinary course of that property business, you'd be able to claim GST on the purchase of the property. That would give you a nice refund, which you could use to pay for renovations, pay for carpet layers, landscapers, whoever. You'd be able to claim GST on all those costs, assuming they're GST registered. But then when you sell the property, you would have to pay GST. 15% of the sale price would go back to the government. So effectively, all things being equal, as a property trader, you should be making a profit. 15% of your profit is gone. So GST is often referred to as a cash flow tool for property investors because it's a bit of a double-edged sword. Gives you a nice little refund up front. You can deploy that in your development activity, but you're going to have to pay that back with interest, 15% at the end. So it is something that's quite confusing. And right in the middle of that is a funny little thing called commercial dwellings. So if you provide accommodation in a commercial dwelling, so a commercial dwelling is a hotel, motel, farm stay, boarding house or similar, so it includes Airbnb, and you have a turnover of more than $60,000, then you do have to pay GST. So the little known sort of fact there is that if you provide accommodation in a boarding house, for example, for more than 4 weeks, you can actually discount the rate of GST that you pay. I think it's down to an effective rate of 9.5% from 15%. And so every now and then I come across new clients who operate boarding houses and have been for quite a while, and they've been returning the full amount for GST purposes. We quite often will go back to the Inland Revenue and claim that back. But it is a difficult area, and something that's quite easy to get in trouble with is GST and property transactions.
Totally is. I've got 2 points on the raise there. I was want some clarity on one, and then I'll give you my example. So you mentioned at the moment, if I'm flipping properties or I'm developing everything, I get GST up front. So if I go and buy a property $1 million and they give me the GST, I'm assuming I get $150,000 on top of that upfront, right, for the cash flow. But you said to me then I have to pay the 15% GST when I sell it. Now, what happens if I now sell the property and it's gone up 300,000, 500,000, 600,000? That 15% at the sale is way more than the 15% I got given in the beginning. But so now I'm actually losing more money to GST than actually the 150 grand or so I got in the front of it. Is that correct?
Yes. So GST is a consumption tax. So what that effectively means is the end user should pay. However, and they do, because in the course of ordinary business, you would charge GST on top of your sale price. But like all things in tax, it's not as simple as, you pay or you don't pay. So first thing to note is that quite often if you are buying a property, you don't pay GST on a plus GST basis, you actually claim the inclusive amount of GST on the purchase. So it's times 3 divided by 23 will give you that fraction. And quite rightly, when you sell that property for a profit, you pay far more GST than you claim. Now, the only final complication in there is that in order to be able to register for GST and claim and pay and be involved in that part of the tax rules, you have to have a continuous or regular activity. And that's something that's different to what's required to meet the threshold for income tax purposes, which is when you carry on a business for a profit. So sometimes there can be instances where you can do something such as buy a property or subdivide a section and sell it and not actually have to register or pay GST. And there'll be instances where you do. So it's something where you do need to get a bit of advice. And one final bit, and this is something that does catch property investors out commonly, is zero rating. If you purchase a property from another GST registered person, then the GST liabilities actually pass through to you. They don't pay and you don't claim. If you don't note that correctly in the contracts, then you can be out of pocket significantly, especially if you are going to sell it to a residential owner. At the end, you're not going to be able to zero rate it, so you're not going to be able to claim GST, but you will have to pay it at the end. So pretty important that if GST is part of your property transaction, that you get your accountant to check it.
Totally. And the last little question from personal experience. So I'm self-employed. So I earn over the criteria to be GST registered. So, but I also invest in property. Now, does the one on the left-hand side automatically mean on the right-hand side I've got to play in the GST game with my properties?
Yes, in some circumstances it does. So remember, residential property where you're supplying accommodation in a residential dwelling is not GSTable. So you could have 20 investment properties turning over $2 million and earn $58,000 in your personal name, not be required to be GST registered. But if you are GST registered earning $70,000 and you provide accommodation in a commercial dwelling, and Airbnb being the most common, so imagine you're a sole trader business owner and you have an Airbnb in your own name. That only earns $20,000 of rents a year. Because you're over the GST threshold in totality, you actually drag that property into the GST net. And that is something that catches people from time to time.
So what do you mean into the net? Because it's on the commercial side, there's GST on that.
Correct, because it's a commercial dwelling. So that $20,000 of income becomes subject to GST. But more than that, quite often you would have to bring the property itself into the GST net, which would mean that you would have to do a change of use adjustment, which happens over 2 balance dates generally. And then you would be up for a large downstream GST liability. So,
but that's only on the commercial one, not on the residential side.
Correct. That's only on the Airbnb. So, couple of easy strategies there. Stop renting it as an Airbnb. If you don't want to do that, change structures in your business. So go to a company structure, for example. And or there's some other little things little workarounds probably outside the scope of the nugget today.
I can always see Matt's mind going in there at the moment, and he's leaving something out there. But as always, Matt, thanks for that one. Those answers, as always. If you got some questions for Matt or myself, our names and our details will always be in the episodes, depending where you're watching and listening. And thanks for joining us for the Daily Nugget, Property Insights Daily, 7 days a week, one question, 20 minutes or less, and hope to see you tomorrow.